Welcome back to The Explainer. Today, we're putting on our analyst hats to perform an in-depth analysis on a really fascinating market paradox. We're looking at Western Union, a legacy giant that Wall Street, frankly, just can't quite figure out right now. Is it a business in terminal decline, or are we looking at one of the most mispriced, deep value stocks on the board?
11.23%. Let that sink in for a second. In a world where finding safe, reliable yield is incredibly tough, an 11.23% dividend is a massive siren song for income investors. I mean, it immediately grabs your attention, right? But as focused learners and objective analysts, we have to ask the hard question. Is this massive yield a hidden opportunity just waiting to be scooped up? Or is it a dangerous value trap waiting to spring on unsuspecting investors?
So here's our game plan for this explainer. We're going to figure out if this is a trap or a turnaround, look at the fintech disruption threat, dive into an in-depth financial analysis, check out the risks and red flags, and then wrap up with scenarios and our final verdict. Let's get right into it.
Part 1. Trap or turnaround. Decoding the global remittance machine. Because before we can judge the stock, we really have to understand the underlying engine generating its cash.
The traditional Western Union business model is actually pretty straightforward. They basically make their money in two main ways: charging transaction transfer fees and making a margin on foreign exchange, or FX, spreads. And they do this across a truly massive global physical agent network. This infrastructure gives them incredibly high penetration in emerging and underbanked markets, where honestly, cash is still king. What's really fascinating here is just how defensive this business is. The data shows that remittances remain surprisingly resilient even during economic recessions. Migrant workers continue sending money home to their families, regardless of global economic slowdowns, and that gives Western Union a very steady baseline of demand. But here's where things get tricky, and it's the absolute crux of the debate on Wall Street right now. Despite that steady demand, a lot of folks view Western Union as a melting ice cube. If you haven't heard that term, it's basically finance speak for a business that is slowly, irreversibly shrinking, even while it continues to throw off cold, hard cash in the present. The market is terrified that physical cash transfers are just a thing of the past.
Moving to Section 2, the fintech disruption threat, or the assassins of legacy moats. Let's pinpoint exactly what's eating away at this company's historical dominance. The battleground here is pretty clearly drawn. On one side, you have Western Union's legacy model, physical stores, frustratingly long lines and cash pickups. And on the exact opposite side, you have these agile, digital-first fintechs and mobile apps. Consumers are understandably asking, why on earth should I drive to a storefront when I can send money internationally from the comfort of my couch with just a few taps on my smartphone? Because of this dynamic, that historical moat is definitely shrinking. You've got challengers like Wise and Remitly aggressively taking market share by offering highly transparent FX pricing and much lower fees. And here's the scariest part for the legacy players: there are literally zero switching costs for digital transfers. Think about it. If an app offers a cheaper rate today, the consumer simply downloads it and switches instantly. Younger consumers show almost no loyalty to legacy brands. So the real threat to Western Union isn't a global recession at all. It's the very real threat of total irrelevance. If they don't adopt their digital mix, their fee economics are going to compress permanently. Section 3. In-depth financial analysis. Let's look at the hard numbers. Let's push past the whole melting ice cube narrative for a minute and actually perform an in-depth analysis on the raw data. $331.3 million. That is a staggering amount of free cash flow generated over the trailing 12 months, especially when you consider their top-line revenue has been stagnant or even slightly declining. But because the stock price has been beaten down so heavily by the market, this level of cash generation gives the company an incredibly attractive free cash flow yield, above 12%. Honestly, very few companies trading at these multiples produce this level of reliable cash. And, to their credit, management hasn't just been sitting on that pile of cash. They've been aggressively buying back their own stock. Back in 2022, they had 387 million shares outstanding. Today, that number is down to 312.4 million. By shrinking the overall size of the pie, they're meaningfully increasing the earnings power of every single remaining share you hold. It's a classic, aggressive capital allocation strategy for a mature, cash-rich business. Now, the valuation is where things get super interesting. The stock is currently hovering around $8 and change, but a discounted cash flow analysis actually puts its intrinsic value closer to $11.50 per share. It's trading at an absurdly low forward PE of just 4.48. But the metric we really need to focus on is the PEG ratio. That factors in price to earnings, growth, And that massive dividend yield. A PEG ratio of 0.40 indicates the stock is highly attractive and deeply undervalued relative to the cash it pays out. That is, assuming those cash flows don't suddenly fall off a cliff. Which brings us to Section 4, Risks and Red Flags, investigating the balance sheet. Because, as objective analysts, we absolutely cannot ignore the cracks in the foundation. Right. So while the cash flow is fantastic, the balance sheet itself is heavily leveraged. Western Union is carrying $2.62 billion in total debt, pushing its debt-to-equity ratio way up above 288%. On top of that, its current ratio sits at a really weak 0.26, meaning its short-term liabilities heavily outweigh its short-term liquid assets. Now, to be completely fair, this debt is manageable right now with their strong free cash flow. But this lack of balance sheet flexibility is a huge red flag. It makes that beautiful 11% dividend yield highly vulnerable if the core business deteriorates even a little faster than management expects. When we synthesize all this into a weighted SWOT analysis, it really highlights the tension we've been talking about all along. On the positive side, you have exceptionally high scores for the low valuation and strong free cash flow. But those are dragged right back down by poor scores in weak revenue growth and the massive looming threat of digital disruption. Altogether, it scores a moderate 6.3 out of 10. It perfectly balances a deep asymmetrical value opportunity against severe structural business disruption. Section 5, Scenarios and Final Verdict, Mapping the Future. Let's lay out some actionable paths for investors based on all the evidence we've just unpacked. If we look at the data, we can map out 3 highly probable scenarios. In the bear case, the melting ice cube accelerates. Revenues decline 4% annually, the dividend gets cut to service the debt, and the intrinsic value drops to somewhere between $6 and $7. But in the base case, if management can simply stop the bleeding, keep revenues flat, and show just a little modest digital growth, fair value jumps back to between $11 and $13. And in a bull scenario, where their digital transition truly succeeds and the market stops treating them like a dying legacy business, we could see multiple expansion drive the price up to between $15 and $18. So if you're aiming for something like a solid 9% annualized return, the sources provide a very clear, mathematically driven entry and exit strategy. The strong buy zone is anything below $8, which gives you a maximum margin of safety. Fair value sits squarely in that $11 to $13 range. And honestly, you should be looking to exit aggressively if the stock pushes past $17, unless you see massive fundamental improvements in their digital market share. Ultimately, our final verdict is this. Western Union is definitely not some pristine, high-quality compounder that you just buy and forget about forever. Rather, it is a deeply challenged business trading at a very, very cheap price. It's a classic deep value income play, where investors are being paid quite generously via that 11% dividend and those heavy stock buybacks to tolerate a pretty high degree of uncertainty. So, I'm going to leave you with this final provocative thought to chew on for your own portfolio strategy. When the cash flow is this strong and the valuation is this ridiculously cheap, would you buy a melting ice cube as long as the price was right? Think about it, run the numbers for yourself, and I'll catch you in the next explainer.